There is, there is a trailer, you can barely see it right there. But it's super, super steep. There's no
morning, everyone. It's 10 o'clock, so we will call the May 9th, 2024 meeting of the Oklahoma City Employee Retirement System to order. Item number 2 on our agenda this morning is to approve the minutes of meeting of April 11th, 2024. I have a motion and a second. Please record your vote. Item is approved. Item number 3 is the consent docket. With one item. I have a motion and a second. Please record your vote. Item is approved. Item number 4 was to ratify approvals. We have 2 items. I have a motion and a second. Please record your vote. Item is approved. Item number 5 is to approve the claims docket. We have a motion and a second. Please record your vote. Item is approved. Item number 6 is to approve the following applications for service retirement. I have a motion and a second. Please record your vote. Item is approved. Item number 7, receive report of death, authorize payment of the $5,000 death benefit, and approve continuation of pension to spouse.
Trustee Dowler, would you like to vote?
You have a motion and a second. Please record your vote. Item is approved. Item number 8, receive report of death, authorize payment of the $5,000 death benefit, authorize secretary to make necessary changes to conform on the following. One case. I have a motion and a second. Please record your vote.
Trustee Dowler, would you like to vote?
Item is approved. Item number 9 is to receive report of death, death of employee while in active service, and approve pension to spouse. We have a motion and a second. Please record your vote.
Trustee Dowler.
Item is approved. Item 10 is to approve request of the following to terminate vested rights and commence retirement benefits. I have a motion and a second. Please record your vote. Item is approved. Item 11 is items for individual consideration. Item number 11A is amendment number 2 and restated audit contract with Allen Gibbs and Hewlett LC to include audit services for fiscal year 2024, not to exceed $27,034. Any questions? This is our annual audit contract. I believe this is the same firm that the city uses? Okay, okay. Chair will entertain a motion on 11A. You have a motion and a second. Please record your vote. Item is approved. Item 11B is the purchase of Kyocera 4054 copy machine and monthly maintenance for use by the ERS Administration Office. Have a motion and a second. Please record your vote. Item is approved. Okay, item number 11C is our personal services contract with Angel Odom, who has been selected to fill the deferred comp specialist position, and she will begin work tomorrow. Any questions? Hearing none, Chair will entertain a motion. A motion and a second. Please record your vote. Item is approved. Just a note before we act on items D and E, we had noticed that when Regina chose to resign and we looked at her contract, that there were some inconsistencies within the contracts of everyone that worked in the ERS office, and all this does is bring the terms of everyone's personal services contract, make it the same. So there's no big changes, but we wanted to make everybody, and that also includes the item that we just approved for Angel. So everyone's contract is going to be consistent with the terms. So any questions on item D, which is amendment to personal service contract with Mary Ellen? Hearing none, Chair will entertain a motion. We have a motion and a second. Please record your vote. Item is approved. And item E is amendment to personal service contract with Michael Truitt. We have a motion and a second. Please record your vote. Item is approved. Okay, let's go down here. Item F is private equity portfolio review. Good morning, Jason.
Good morning. So this morning we have a recommendation for a new private equity fund. As you'll note, we probably will have 2 or 3 a year. When we do this, we do a review of the private equity portfolio overall, how's it performing, and just some background. So I'm going to turn you to page, a lot of pages before we get to anything, 5, which is a review of your private equity performance for your overall private equity program over time. One of the things to keep in mind is we go back, you made your first commitment to private equity in 2008. At that time, the target allocation to private equity was 5%, and we made 2009, I should say. We made 2 commitments to fund of funds at that time that would invest in, you made a single investment, and those funds invested in multiple funds. As you've grown, and we've been able to, what we would call disintermediate that second layer of fees and build a portfolio of primary funds investing in direct partnerships, and that's been diversified across different types. In 2018 or 19, we hit that 5% target. We bumped up the target to 10%, and then in 2023, we bumped up the target to private equity to 15%. As we sit here today, we're at about 8.9%. It takes, unlike your public equities and fixed income, it takes time to get to that target. because decisions that, when we are recommending a fund to you, we are recommending a commitment amount, which is a dollar amount that you will fund to that partnership over the life of it, typically the first 4 to 5 years, and then they will invest in companies, improve those companies, sell them, and send money back to you. So it requires an ongoing commitment program, and we'll get to that in a moment. But as you see here on page 5, the performance of your private equity portfolio has been very good. More recently, and I've talked quite a bit about this, because we're comparing to a public equity benchmark in your overall policy, which is the S&P 500. Last year, the S&P 500 was up 24% in 2023. It's been the best performing asset class, large cap U.S. equity, the last decade. So it's been a pretty hard hurdle to beat. Over that 10-year period, however, your private equity portfolio is up 15.5%. This is ending December of 2023 because that's the most recent time period for full data on private equity. Your private equity portfolio is up 15.5% versus the S&P 500 plus 2.5%, up 14.6%. So you're getting that 2.5% premium to public markets. We're also showing versus a global equity benchmark plus 2.5%, that's the ACWI. More recent 5-year, about in line with the S&P 500, but when you add on another 250 basis points, a little bit behind, and 3 years ahead of that. And much of that is the last year as private equity valuations have moderated. You've seen markdowns in 2023 following public equity declines in 2022. Private equity lagged, and you had a downturn in 2023. But overall, good results. The next slide just looks at the history and some other metrics that we're looking at. So you'll see all of the commitments that you've made going back to April of 2009. And just I'll give some definition around these categories at the top that you see there. This is in every report. This is in every ASAP and every quarterly report. That top line, inception date for the total fund, that was April 2009 was when you made your first, that's when the first capital was drawn. The commitment might have been a little bit earlier than that in late 2008, but the first time that capital was drawn was April of 2009. So you see some of these funds at the very bottom, Francisco Partners and Clayton, Dubilier, and Rice, you made commitments to them in 2023. They haven't called capital yet. They haven't drawn any capital down. Both of those have made some investments because they use a credit facility to make investments, but they haven't called capital from investors. When they first call capital from you is when that will be reflected. But in total, since 2009, you've committed $154.5 million. $91 million has been drawn, meaning those partnerships have called that money from you. It's been invested. Some of it goes to fees and expenses, but a majority of that is going to investments. So there's a remaining commitment to these existing funds of $64 million. Distributions, this is realizations where these partnerships have improved the businesses and sold them and actually sent money back to you. So while $91.1 million has been drawn, you've received back $71 million in distributions. And that's recycled into whether it's the private equity portfolio or other areas of your portfolio, depending on timing.
In this market, what do you think is a good benchmark? Is it 1.5 times? Is it 2? I mean, we prefer 3. Just want you to know that.
As far as a
or 4.
multiple?
Yeah, multiple. I prefer 3 or 4, but no, I'm just kidding. But what's
It depends on the fund type. So typically for venture funds, direct venture funds, we're looking for a 2x multiple at the end of the game, right? That's the other challenging part with private equity funds. It's difficult to measure while the game's still going on. But typically a 2 times multiple for venture funds would get you a 15 to 20% IRR because of the time.
Right, you got to go out further.
Because a venture fund is going to be a little bit longer life. Those are typically 12 to 15 years. For buyout funds, those are typically at 8 to 12-year life, and we're looking at about a 1.8 to get you to that 18 to 20. For some of the others, which if we go all the way back to that Singular Gulf Distressed Opportunities Fund, and you'll see on another page here, distressed or what special situations more broadly, these are more opportunistic type strategies that are trying to take advantages of dislocations in the market. Typically, they're able to get money to work a little bit quicker and recycle it a little bit quicker, so the multiple will be lower, but you get a similar IRR. So that 1.6 multiple on that Singular Gulf fund, we're not showing the IRRs on here, but that's going to be a double-digit internal rate of return.
These multiples are not time-weighted, right?
That's just, that's for every dollar in, that's what the total, if you take the adjusted ending value and the distributions, that's where you are today.
Okay.
It's another measure used for private equity.
Yeah.
But go back to the page before, because I didn't really explain it on the performance page. So what we're doing here is these are time-weighted rates of return. We're converting to be able to make it apples to apples when comparing to public benchmarks. What we're doing is saying, okay, when we put dollars into the private equity portfolio, if instead we put dollars into the S&P 500 or the ACWI, and when we got money out of the private equity portfolio, if we took it out of that benchmark, what would that return be? It's a public market equivalent. So it's a different way of calculating a benchmark, because we know the actual money-weighted or the time-weighted rate of return, this is money-weighted. The time-weighted rate of return is going to look a little bit different because we're not controlling, you're not controlling when the money's put to work or taken out. So it's to make it apples to apples. If we go back to the next page, Mary Ellen, thank you. I think I touched on all that. Just the adjusted ending value. What we're doing there is we're looking at the most recent carrying value from all of the partnerships' quarterly statements. And I say most recent because there is a time lag. So some we may only be reflecting 12/31, or in some cases, I don't think so now, it's May 9/30 valuations, because there's a lag in the reporting, typically a full quarter. We're adjusting that based on any capital calls or distributions that have occurred from that partnership since that time. So if they've called more capital and got more, we're adjusting that up or down, or if they've distributed money back to you. And the total value, as I mentioned, is the adjusted ending value plus distributions to get to that total value to paid in. The next page just looks at the timing and how we've, diversification by time and diversification by type. The portfolio is the two major areas. If we think about equity, you think value and growth. Within private equity, it's more buyout, growth equity, venture capital. So buyout is typically, these are funds that are investing in more mature companies that are a little bit further along in their life cycle. They're profitable, generally profitable, more mature industries, industrials, services, other things. Whereas venture and growth equity is typically going to be more technology-oriented, healthcare, again, earlier stage, less mature companies. And then we have a small piece in what we call special situations or credit and other things, which is the distressed component. So you have good diversification across types, also across time. And this is really important within private equity. We don't, generally the best results occur when you're putting money to work at the worst times. So after 2008, when the market was really depressed, after 2001, after the tech bubble crashed, were really good times to put money to work at lower valuations. So we're trying to stage money into the markets over time and hit different economic cycles. You'll see the 2021, 2022, and 2023, over 50% of the commitments have been made to funds in those years. That doesn't mean that dollars have been put to work in those years. There's still a lot. That's almost 70 million of unfunded commitments. That's more a reflection of increasing the target allocation. As the target allocation has increased, we've had to bump up our commitment activity. The next page just shows another look at diversification across types and the funds you're in. This doesn't represent all of the funds you're in historically. This represents, well, actually it might, but these are active funds that are still putting money to work in your portfolio. Similar to the a style box, if we looked at large cap, growth, core and value, mid cap, small cap, it's a little different look. How we're framing this is on the growth equity side, venture capital to growth equity, seed stage to late, it's basically seed, which would be the ideas, investing in someone's idea that's Steve Jobs putting computers together in his garage. You know, unfortunately, we don't have that in this portfolio, but that's the kind of thing that we're talking about at seed stage. Most of what we're doing is what the First Mark strategies and TrueBridge. TrueBridge is a diversified venture fund of funds. That's more early stage. So a little bit later on, they're in the development of these companies. And then growth equity is Warburg Pincus, which has been a foundation piece in this portfolio. As you move to the right, looking at buyout, again, more mature companies, we do break that market down by size from small market, mid-market, and large market buyout. So CD&R and Apollo are really operating in the large market. So examples of, think of when Hertz rental car went private. That's a buyout transaction, but a very large company taking a public company private. Versus what Sawmill is doing is more smaller end of the market, bite size of buying companies that are 10 to 50 million in revenue, typically family-owned businesses that are needing the next stage of capital to grow. We've got one commitment on the special situation side, really two. The Singular Guff early on, which we're not showing because it's wound down completely now, but Carval. Carval was a distressed strategy that was raised right at the depths of COVID with expectations that there was going to be a lot of deep value and discounted opportunities to take advantage of. That didn't really materialize with what happened in the markets, but that's what that is. So the fund in the gold circle today is Berkshire. It is more of a mid-market strategy. We have some exposure there through the Mesirow piece, which is winding down, the Francisco Agility, which is primarily technology-oriented buyout. Berkshire Partners, we think, could be a good complement in the mid-market space, doing things a little bit bigger than Sawmill, smaller than Clayton, Dubilier and Rice, and Apollo, and the main Francisco Partners Fund. And I'll get to more detail on that in a moment. If we go to the next slide, this is what we call a pacing plan. I know every time we show this to anyone, we get a lot of questions about, well, are we locking ourselves in? All we're trying to do here is come up with a reasonable number for the next 12 to 18 months that we need to commit to move toward our target and not get too far over our skis. So the way this model works, it's looking at basic assumptions, what you just asked, Brent, for venture funds. We're using a 2x multiple at the end of the day. We're using a 12-year time horizon for those funds. For buyout, we're using a 1.8 multiple and a 10-year. And for special situations, which we're not really putting in here because we're not doing a lot of that. It would be a 1.5 and about an 8-year or 6-year time horizon. But this is looking at your existing portfolio and then what we would do going forward. So basically, right now, your private equity, and this is the number there, that 76 million, that's probably as of a couple months ago, but we're right about there today. I think 77 million at the end of March, so that might be, I'm not sure what data they use, but we're right a little under 9% is where we are today. And you can see this is a pretty conservative approach. This is assuming that we put make 40 million of commitments this year, next year, and then 30 million the next 3 years. That would get us to a little over 15% by 2028. So really all we're focusing on is this year. So based on this pacing plan, we're very comfortable that putting 40 million to work in 3 to 4 funds is going to move us toward that target. One could argue that you've got room to actually do more. We could do 50 to 60 million, but we want to stage it in appropriately. What we don't want to happen is if you have a major sell-off in markets, the denominator of where that private equity portfolio goes down, but we have a lot of unfunded commitments that we have to make, and then we get way ahead of ourselves. So based on this pacing plan, we're comfortable with a $40 million pacing plan per year. We're not locking into these out years. These numbers are going to move around. The next time we show you this pacing plan, those numbers could be higher, or they might be a little bit lower depending on what the overall portfolio does. Does that make sense? Okay. If we go to the next slide, please. This is just looking at our pipeline of funds, just kind of give you some sense. Today we're going to talk about Berkshire Fund 11. The second half of this year, there are some funds in the market that we're looking at. One that you're currently in, that Carval Credit Fund 6 is coming back to market. We're still doing our diligence on that and making some determinations on that. There might be some other distressed strategies that might be more compelling in this market that we would consider. Some other new names that we don't need to get into today. General Atlantic is a growth equity fund, a lot like Warburg Pincus. They're pretty similar in size that they're doing. We would probably wait for your portfolio to next 2025 and look at Warburg Global Growth 15, a fund that we're in and have been for some time. If we go to the next 2 pages forward. Berkshire Fund 11, which is the fund that we're recommending today, obviously with a Roman numeral 11 behind it. This firm and team has been doing this for a long time. They have a very long and successful track record of doing control-oriented buyouts, meaning they're buying controlling interest in private companies, primarily in the middle market. What does that mean in terms of size of the funds that they're investing in? These are going to be, the lower right here, you'll see these are funds with enterprise value of 200 million to 2 billion. So in terms of public markets, this is small cap or micro cap size companies. They're not doing the mega buyouts. In the private markets, we would consider this middle market. Revenues of 25 to 75 million. As I mentioned earlier, Sawmill in the small market, they're looking at companies that are 10 to 50 million in revenue. So this is a little bit further upstream. They're going to do 20 to 25 investments in this portfolio, and for each company they're writing, they're investing 100 to 500 million. Some of the really compelling things for this fund that we would say, if you look at the GP commitment in the strategy information, the general partner or the investment team of Berkshire, at a minimum, they're putting 8% of the capital in the fund alongside of all of the investors. and about 520 million based on the target fund size. So that's a meaningful investment by the partners, which we really look for is that alignment of interest. This fund, they've closed on 5.2 billion as of this month, and they're going to have a final close in July. So this is one where we've got a fairly narrow window.
Jason,
Yep.
what is, when you're talking about the general partners, when you say it's widely spread fund economics across senior professionals, could you explain that a little bit?
Yeah, so the way the fees work on this, there's a base management fee, and then there's the incentive fee. So the incentive fee is really how the partners get paid. And what we like to see is that carried interest being broadly spread around the investment professionals, not highly concentrated in a handful of people. So that the incentive to do well is broadly spread around the entire team. Page 13, we look at their prior funds going back to 98, not all of their prior funds, but going back to 98. Their 5 most recent funds, looking at the performance that they've created in these funds versus the public market equivalents, just like we looked at your portfolio, and you can see pretty significant premiums to U.S. large cap and small cap, all well in excess of that 2.5% premium that we're looking for over time. So a very strong track record. Next slide just looks at it a little bit differently relative to peers. For the most part, the very far right, you see their total value to paid in, which is that multiple that we were looking at as far as where it ranks in the quartiles versus other funds of similar ilk. Maybe go the net total value to paid in, that's the actual, what you were asking, and you can see the multiples on their funds. They're more mature funds going back really to the 2011. 2016 and 2021 really aren't mature yet. They're still in their earlier stages. So the one that stands out maybe is that 2016 fund, still very early on. A 1.7 multiple, which we like. Typically for buyout, we're looking for 1.8. That happens to be right now, 2016, the best year for buyout funds in a long time. And so that's putting them in the third quartile as of now. They've got a couple of deals that are about to close that we think will bump them up over that. But still a 16%, over a 16% IRR, so we're not concerned about that. But a very good long-term track record. So in the end, what we're recommending, again, to continue to build out your private equity program is a $15 million commitment to Berkshire's Partners Fund 11.
Okay. Anyone have any questions for Jason on his presentation? Okay, since item F was just the portfolio review, we don't need to take a vote, so that'll take us to item G, which is the private equity commitment of $15 million to Berkshire Fund 11. Chair will entertain a motion. We have a motion and a second. Please record your vote. Item is approved. Okay. That takes us to item 12, which is to receive the investment consultant report.
Still me.
Still you.
Okay. I'm going to just touch on the quarter report. If you go to page, well, that's a good one. We'll start there. Wait, good spot to start. So this is the quarter report through March, and I'll just point out The one-year returns, you see where the S&P 500 is, up almost 30% year over year through March. The best performing asset class by far. So small cap stocks did really well. Up, that's the Russell 2000, up just under 20% at 19.7%, but that's about 10% behind large cap. So when we think of how portfolios are allocated and relative to peers, the more diversified you are out of large cap, the less good you're going to look relative to peer groups. And I would say this portfolio, along with many of the portfolios we work with, relative to peers, and we've drilled down on this a little bit more in detail, and I'll come to that in a moment, a little bit less large cap exposure. Not necessarily to small cap or international, but you have non-traditional assets as well, which we've talked a lot about. So the more private market assets you have, which isn't just private equity, but real estate, you're gonna, and taking away from large cap US equity in the short term, that's gonna have impact relative to peers. So just pointing that out. So if we go to the next, keep going all the way to page 20. I always think it's good to look at dollars. If we look at the last 10-year period, so as we stood here in 2014, the portfolio was at $638 million roughly. Net additions, this is benefit payments coming out and other expenses plus contributions in, negative $265.5 million. That's typical that you'd be negative net cash flow for a mature pension system. The return on investment over $500 million in that 10-year period. So ending market value at $887. The 1 year, just from a dollar basis, that 1 year period ending March, the portfolio returned just under $100 million. The 3 years, you see it's a little bit less, and that includes 2023. So this is the challenge when you're up and then down. When you're down, you got to be up more to get back to where you started. So historically, one of the things that we've tried to do with this portfolio through diversification and some non-traditional assets is to, we want to participate when markets are going up, but we want to protect when markets are going down. So if we look at the next page, you see just from a very black and white objectives, return and risk over longer periods of time, 5 and 10 years. You're meeting all of these objectives over those longer periods of time. So that first one is your actuarial rate of return. From a return standpoint, this is the most important. You've been, from an accounting standpoint, you've been thoughtful and conservative in bringing that down. Currently, it's at 7%. I think that's right around what the average is or the median for public pension funds across the country. I know there's a lot of talk today, should we be with public pension funds as expectations, because interest rates have gone up, have improved a bit. I think remaining cautious with your assumed rate of return is appropriate. But over the last 5 and 10 years, we've achieved that. Relative to the policy index, which is what the asset allocation would suggest, over 5 and 10 years, outperforming the policy index. The 1 year, we're trailing that policy index, but it's up well above that 7%. And then the last 3 there are risk metrics, so we want to be lower typically. The first is volatility or standard deviation. We have a lower standard deviation than the policy index, and what I'll show you in a minute, relative to peers, quite a bit lower standard deviation. Beta or sensitivity to the direction of the market's a little bit lower. A beta of 1 or above 1 would mean you're going to be more sensitive to the direction markets are moving. We're a little bit less sensitive. And then finally, down capture. Pretty good down capture. What this is, I use those terms, participate when markets are up, but protect when markets are down. What this is saying is when the policy index, which is broadly public markets, stocks and bonds, are down, you're only down 90% of that. So if public markets are down 10%, you're down 9%. And so being down less over time is helpful in compounding assets. If we move forward to page, let's go to 26. So the 1-year return here, 11.4% net of fees, 1188 gross of fees, and we show gross because we're showing a universe that's gross. So a little bit behind the policy index, which is up 12.4. Most of that, as we've described in great detail, is private equity being compared to the S&P 500. Your private equity is almost flat, S&P 500 is up 28% for the year. Relative to peers, the median in the public fund peer group is up 13.5%. If you go back to page 24, on that 1 year, the standard deviation of your portfolio is up 9.7 relative to the policy index of 10.4. A little bit ahead of the median public fund, but if we go out further in time, looking at 3, 5, and even 10 years, your standard deviation relative to the median public fund is well below that. And this is an indication of diversification. Number one, private markets, real estate and private equity, we have more of that than the public fund peer group. And as we've drilled down on this peer group, if we go back to page 26, you see at the bottom observations, 280, different time periods, there's slightly different observations. This is the number of observations in the peer group. We're running, the peer group data gets updated throughout the quarter. This is a pretty early cut. It doesn't change that much, but about 65% of these observations are public funds under 100 million. So they're much smaller. There are a lot of smaller municipal plans. Typically what we're seeing with those is the allocation to US large cap equity is significantly higher. The use of mutual funds is higher, and that's why why it's populated so quickly. When we look at this versus a universe over $1 billion, which I know you're not over $1 billion, but you're close, the standard deviation of your portfolio looks a lot closer to the standard deviation of portfolios over $1 billion. So I point that out because in short periods of time, while we're up 11.4% or 11.8% gross, and you look at the median in this peer group up 12.88, you say, well, that's a pretty big difference. There's a pretty big difference in what they're doing and what you're doing. Over time, if we go out over 10 years, as of now, we're right at the 50th percentile. And this has moved around a bit. I'd say private market investments has been a headwind over the last year. It's helped out over time. Just if you want to go, if you can open the ASAP monthly report and go to, I don't have, one more page. There we go. Okay, in terms of the asset allocation today, this is at the end of April. You can see we're 5% over target to equity. We did do some rebalancing in the month of April. We took $30 million from large cap, which is the most overweight, and put $16 million in cash for a quarter's worth of cash needs, and $14 million into fixed income, and we split that between Western, the Core Plus manager, and SSGA, your core manager, to get fixed income up a little bit. The deviation from the targets at the overall equity and fixed income level is a result. We just changed the targets at the beginning of the year in February. We decreased equity by 5%, and we increased fixed income by 5%. In addition, we eliminated long-short equity. You'll see the target allocation to long-short equity is 0. Right now it's still showing 6. Those redemptions have been, you've put them in for the end of June. We expect to get that money back probably mid-July and into August. It will take a little bit longer to get all of it back, but at that time, we'll be rebalancing even more. But we did do some this month from taking 30 million from large cap. So just wanted to, that's what that major deviation is. We covered a lot. I'm not going to roll forward another month, but any questions on the?
I just have one. When you're calculating gross fees and net fees, is the difference just your fees or are other fees involved in that?
I'm sorry, the difference what?
Is the difference just your fees and the gross fees and net fees, or
No,
are
those
there
are
other
manager
fees?
fees,
Okay,
management fees.
so,
Our fees are so insignificant, it doesn't move the needle.
okay,
It would be all of the manager fees.
okay,
That's why it's about 50,
right, 50 basis points.
right. Our fee is 1.5, maybe not even that.
Jason, do you have the most recent capital market assumptions? I think you said you guys do that at the end of the year, right? In the past, when we talked about it?
We reviewed that at the January meeting, but if you go back one slide, I think.
There we go.
You can, the lower left, these are our 2024. I mean, it's hard to read that, what those are, but.
Yeah. The reason I bring that up, I think, you know, as we look at the last 10 years and 15 years of returns for the S&P, it's easy to forget the lost decade that, you know, from 2000 to 2009, where the S&P didn't do so well at all. And so it's easy for investors or for us here to say, well, why don't we put more in S&P since it's done so well in the last 10 years or 15 years? But we have to remember that the longer and longer something outperforms the long-term average, the more likely it is to underperform in the subsequent 10, 15 years.
Large cap assumption is below the long-term average, but it actually went up slightly this year by like 2 basis points or 20 basis points. But it's 2 years ago, before 2022, before the market sold off significantly, our expectations for large cap, our intermediate term, was in the 6% range. So that was really reflecting how good U.S. equities had done for a decade.
Yeah.
And that's gone up a little bit just because of the sell-off in 2022.
With 2023 having such a high rate of return in that asset class, I'm surprised that it was adjusted up versus down. Could you educate me on that a little bit?
Sure. So valuation is one component, but we're looking at 10 plus years, not the next year. And earnings expectations were up, which is another factor. And so that ticked it up slightly, but still we're about 200 basis points below the historical average. So in the middle of this page, we show what we'd call more of a tactical near-term outlook. This isn't for asset allocation purposes. This might be if you're rebalancing. We're looking at just based on where valuations are at the moment relative to historical, what's expensive and what's less expensive to maybe inform rebalancing decisions. And you'll see large cap is the one that's overvalued. And that's why we're taking from large cap and rebalancing into other asset classes.
Finally, I definitely appreciate the transparency with, you know, that report as how our fund has performed versus a peer group. I know it wasn't the most, you know, it's probably the least, you know, the report that you least like to go over, but it is what it is. Being so close to the $1 billion point, where we really should be looking at the next bigger group, at what point do we start comparing ourselves to a different peer group?
Yeah, they're in there. I mean, I was really trying to point out, there's issues with peer group. You really need to understand what the peer group, what's in that peer group. It's not as if the $1 billion funds aren't in that peer group. They're in there. It just doesn't make up a large portion of them, of the observations.
Okay,
So we could show that too. It's,
yeah. Okay, thank you.
any other questions?
Any questions for Jason? Okay, hearing none, Chair will entertain a motion to accept the investment consultant report for this month. We have a motion and a second. Please record your vote. Item is approved. Okay. Item 13 is comments from board, staff, and citizens. Hearing none, we are adjourned at 10:51. Thank you, everyone.